Good afternoon and welcome back to the weekly market analysis for October 24th through October 28th. Be sure to smash the like button and subscribe if you have not already done so. I appreciate your support. We've got a lot to talk about today as we dive into the markets. What I've done today is I thought it'd be good to revisit our long-term moving average, our 50-day, 100-day, and 200-day simple moving averages when we look at the equity indices. And then we'll see if they're applicable to other things. Some of you might remember in my videos from February, March, and April that I was looking a lot at the moving averages, as they are definitely good to watch for momentum, for long-term momentum and the long-term trajectory. Last week our video was talking about whether or not the bounce was going to have some legs, and after the last week of price action, it sure looks like even in spite of bad tech earnings, there's some caveats to that I'll talk about in just a second, that in spite of tech earnings, there are the markets are still up on the week. In fact, if you go and you look at the S&P 500 on a weekly chart, the S&P was up almost 4% on the week. The big winner this week was the Dow, going up over 5% on the week. And what's noticeable on the Dow, and the reason I'm showing the moving averages, is because over the last week alone, the Dow has made it above all three of its major moving averages. And the last time that it did that was on the last bounce from June into August. The last time we made a bounce like this, the Dow got barely over its 200-day moving average, and it lasted for about 3 days worth, or about 3 or 4 days worth of time before coming back down. And obviously you might remember back Jackson Hole was happening on August 26th. It was right before that we had bounced off of we didn't bounce off of resistance, because back then, excuse me a second while I'm messing up my chart here. There we go. Because back then the chart was right there, and we kind of had we had a little pop-up above that, and then if you recall, once per my rules of TA, once you make a lower low, then you move the trend line to the top of the next wick, and so that's what I did. And so you can see we're coming up real close to that trend line after having just popped above the 200-day moving average. This is a really big moment on the Dow. There's a lot of evidence to suggest that, I have never said that we've been in recession at all this year, although I will point out that we finally did get an inversion in the 10-year 3-month curve. We did get an inversion. Now we got to see this inversion deepen a little bit and then stay inverted for a couple of days before this becomes really noticeable, but I did want to call that out. But up until now, the economic numbers are still coming in showing things relatively strong. We had Q3 GDP come in, and it was over 2%, or 2 or 3%, something like that. I don't remember off the top of my head. And this is why, and I previously I was talking about the outperformance of the Russell, which it had been, but now it looks like we've shifted over to an outperformance on the Dow. If you go from the bottom, we'll go from the October 3rd wick. If we go just from the wick bottom, we're up over 15% on this bounce in less than a month. And then if you go from the wick from October 13th, then in the last 13 days, in the last 15 days, the last 11 trading days, we've come up 15%, which is pretty remarkable stuff. So let me get my moving averages back on. So this is it's a big deal. However, remember the Dow is only 30 stocks, and they are more cyclicals than anything. And so they obviously are not fully representative of the entire economy, although they are equal weighted, which I think is interesting to note. So I wanted to show you guys that. And we're just quickly looking at the equity indices so that we can kind of set a baseline for the things that have been happening. You can see here on the S&P 500, I've got price coming into this area of light resistance on a descending trend line. It also coincides with this this horizontal level that I've kind of adjusted it at different points this year. I'm not really sure which level is important. It might be this level going from the closing high of the June 24th wick. That looks like a much better level that we tested and stayed below, and then came up and retested, and it coincided with the 50-day moving average at one point. On the S&P, we have closed above the 50-day moving average, and by a couple bucks, by a couple points, closed above the 100-day moving average. But again, we're into kind of an area, and it doesn't really matter where this horizontal trend line goes. Resistance is never as thin as the trend line, even if sometimes they do touch perfectly. But they are areas of resistance, and so it's light horizontal resistance and light trend line resistance coming in at around the same spot. So you got to call out that confluence and be aware of that. We do have a little bit of space, about 6%, 6.5% of space between here and the top trend line, and then we've got between here and the I don't know why that's happening. And then between here and the 200-day moving average, we have about 5 to a little over 5% of space. And so we still have potentially some room to run up there, although I don't think that it will. Let me just really quickly go to the NASDAQ and then the Russell. The NASDAQ is the underperformer. It's been interesting. So what's the deal with the NASDAQ price action? The NASDAQ, although it outperformed today, mostly because of Apple, as well as many other tech names doing pretty well, in spite of Amazon being down pretty deeply yesterday after hours and then early this morning. The NASDAQ, on a relative basis this week, is underperforming. The weekly performance this week was only 2%. That is, I know it's less than the Dow. That is also the S&P was just under 4%, and then the Russell was 6% on the week. So the NASDAQ was the underperformer on the week, and that's obviously having to do with the earnings of the mega cap stocks this week. So if we just look at a couple of them, looking at Facebook, you can just see that ugly gap down. If you look at the earnings and revenue, TradingView will import them. The revenue came in above the estimates, but it was below on earnings. The earnings per share was below, and the guidance was very, very disappointing. And then another one from this week was Amazon, and we had a pretty significant gap down. We closed down 6.8%, but if you go from the close of yesterday, at one point it was down to almost 12%, and that is obviously, again, as a result of look at this earnings. The earnings per share was higher than expected, but the revenue was down a tad, and the forward guidance was not good. And then that you contrast that with Apple, which was up at one point was up. Let's see. Let me just go from the close here. At one point was up almost 9%, but obviously closed about 7.5% up. It did touch its 200-day moving average, and its earnings were good. Although yesterday in after hours it sold off at first. And then it ended up coming back up and really leading the market in a very strong way. So anyway, the other indices today were pretty good. The other tech stocks, other than Amazon, the other tech stocks were pretty good in the index today. And so the NASDAQ did outperform on the day, but not on the week, obviously. And I think the reason why it's lagging is because it's been having to deal with the large weighting in the NASDAQ from those big mega cap names. So that's kind of where the equity markets are right now. If we look at the dollar really quick, the momentum is still very strongly above the 200-day and above the 100-day moving average. I do want to call out, because I've been talking about this on Twitter, that there have been multiple instances since the bull run in the dollar started where the dollar slipped below the 50-day. It has not gone below the 100-day it hasn't been below the 100-day moving average since June of 2021. So that's notable. So I don't think that there's any. I'll just tell you my bias here is that I don't believe that anything in the macro has sufficiently changed in any material way to indicate that the dollar has topped. There are a lot of people saying that this is it. This is the macro top on the dollar. There are some who are saying that this is just a near-term top on the dollar. I mean, obviously it's a near-term peak. This from the wick top on September 28th. We are now 30 days, 22 trading days later. These long consolidations, when they've happened, they have been pretty long from top to bottom. 28 days, 20 trading sessions from July into August. If you go from this wick, you have 17 days, 11 trading sessions. If you go from here, you have 24 days, 18 trading sessions. So point being that these consolidations can take a lot of time to work themselves out. And especially the reason why I highlighted those instances is because those are the places where my SAMS indicator showed an exhaustion reading in terms of price action and strength and stuff. So I just wanted to call that out. I do think it is notable that we closed a couple of days ago below the 50-day moving average and came up and tested it and failed to close back above it. That was something I was watching for because it happened back here in August. It happened back here in May. And it happened on a couple of instances over here in January and in February. So that is something I'm watching for to regain momentum. To me, it's just a mean reversion right now. And again, I don't have the articles up. I don't have the stories up. But the ECB hiked 75, but they came off a lot more dovish. The BOJ continued its commitment to yield curve control, holding the JGB's 10-year at 25 basis points. And so as long as those things continue to be the case, I don't see any reason to expect that the dollar macro top is in. I think that, I don't have the tweet up, but I basically made an illustration that looked like that and said that that's probably what we're going to do. It's kind of similar to the call that I made on crude oil over the summer, which happened a lot faster than in my time horizon. So I may not have the timing exactly right. And I'm not talking timing I'm not talking about 6 months to a year. I'm talking about a couple weeks probably that this could happen, maybe a few months. But whatever the case may be, I still believe that we're going to make new highs before this is all over. And we'll see going into next week, because next week we have the FOMC meeting on Tuesday, November 1st, and then November 2nd on Wednesday with the press conference, press release, and Powell talking. And so I want to talk about that in just a minute, but before I get to some of those other discussions, I want to take a look at the euro. So we'll go euro US dollar. We came up and tested the 100-day moving average. It's been a long time since we tested the 100-day. It's been since February. Again, this to me is more of a mean reversion. It is significant that we made a higher swing high here compared to October, but we were very deeply oversold here. And I think that this level is more likely to hold again in the macro, with the Fed continuing to tighten and the ECB dealing with bond issues, dealing with energy issues and things like that. I can't imagine that unless there's a material shift in those or in the Fed, that the euro should be bid or that the euro bottom is in. It did come back below parity, so I think that's something important. It could not hold this move above parity that it had. Another thing I wanted to look at was the US dollar Japanese yen, which also still hasn't even come down and touched the 50-day moving average in spite of the intervention by the Bank of Japan and otherwise. I do want to call that out. The momentum is strong in favor of the long side. To me, this is just a simple consolidation, and I think it's really important to just continue to point out for Japan, until Japan capitulates on yield curve control, I don't expect that the yen will do anything but continue to depreciate versus the dollar. I don't see how the top is in, because they haven't materially changed their policy. And they're going to continue to let the yen die versus letting the bond market die. Even though I've heard, you might have heard a lot of podcasts or a lot of people saying, that the Japanese can intervene in the currency markets for some time. I don't doubt that that's true, but the long-term trajectory is that until they materially pivot from yield curve control, there's no reason to expect that the yen will be strong. And even if the Fed changes direction, if the Japanese don't change direction, then at best this market, like everyone's expecting that this is just going to go like this, or maybe that's not accurate. Maybe a lot of people are expecting it to go like this. If only the Fed capitulates, then I think it's like this mostly. But then and it doesn't really matter what the Japanese do, in that, unless the Fed pivots. If the Japanese pivot, then you'll probably see that chop as well. But if nothing changes and nothing has materially changed, we're still going to see this to the upside. So I think that that's important to call out as well. Okay, now I'm going to go back to equities here for a second. So what's been interesting is to watch the rate hike probabilities based on the euro dollar. I usually show you on a chart, but this looks a little bit better. The rate hike odds, 81.3% calling for a 75 basis point hike. But what's interesting is this 18.7%, because if you look down at the table at the bottom, 1 day ago, this was at 11.5% for a 50 basis point hike. And then last week, it was at 5% for a 50 basis point hike. And so, I mean, we were at one point at 95%. And I think that we have to consider the fact that a lot of this price action potentially that we've been seeing is in relation to what we talked about last week with Mary Daly talking about who, by the way, is a non-voter for the FOMC, talking about stepping down rates. I'm not saying that they won't step down rates, but I think the more important thing as we go into next week's FOMC meeting is not whether they talk about tapering the rate hikes, like lowering the pace of the rate hikes. To me, it's what do they say about, cutting rates, for example. What is the forward guidance, if any? I know that they said that they wouldn't do forward guidance anymore, but they basically are. The idea of higher for longer. I think it's important because, if you go out to, where are we here? If we go out to like the March contract, or let's go to the May contract out here, the highest probability odds even going out there is that the federal funds rate is going to be at 500 basis points. I mean, that's really high. That's way higher than it is right now. And so I just think that right now the market is getting so excited about a pivot. We've had a lot of things going on. We've had, the Bank of Canada and I think the Bank of Australia, who hiked less than what was expected. You have Mary Daly last week talking about how she thinks that they need to step down the rate hikes. You have a lot of people thinking that the rates are going to get cut. Everyone's looking for the pivot. And it's just so hard to see that coming because PCE, which came out today, which it's really interesting. It's like the markets don't care about PCE. And I think there's a lot of other things that were going on with that. I'm just trying to go through some macro stuff. PCE was the same month over month as it was last month, which was higher than it was the previous 2 months. And that's headline PCE. And then core PCE was 0.5, which was what it was forecasted, and which was the same as last month, which was higher than the previous month. And then the year over year numbers, PCE is the same as it was last month, and then core PCE actually was up. So the last two prints have gone up. And this print is even higher than our print from June, which was allegedly where peak inflation happened. So I think that's something to call out on my table that I have for myself. What I did was what I always am doing is I'm updating the annualized 2-month SAR, 3-month annualized for both PCE and core PCE, along with other inflation metrics and stuff like that. So one thing I do want to call out is on a 3-month annualized basis, headline PCE is at 2 now, which is a lot of people will look at, oh, PCE's at 2%. That's exactly what the Fed wants, but where it's not at 2% is core PCE on a 3-month annualized basis. We did fall on a 3-month annualized basis by a little bit compared to August, but we're higher than we were in July, which I want to call out. And it still is one of the higher. It's the third highest reading over the last 6 months. And so I don't want people to get too excited. This number needs to be at 2, and it's not at 2. And until this number is at 2, I have a hard time believing that the Fed is going to. If this number's not at 2 or even remotely close to 2, then I don't see that the Fed will. I'm not saying that they won't raise rates at like a lower rate or like a lower amount, because eventually they're going to. And their own dot plot says that they're going to. They can't raise 75 basis points at every meeting all the way through next year, because they don't even think that they will need to do that. So this whole idea that the market is saying like, whoa, this is a big deal, they're going to slow down rate hikes. I mean, the Fed has been telling you they've told you already that they're going to slow rate hikes. So I do want to call that out. On an annualized basis, a 1-month annualized basis, I should say, core PCE is at 6. And the 2-month annualized is 6.6, which is higher than it has been since January, or since before, actually way before January. Let me go back a little bit further and see if, wow, yeah. So on a 2-month annualized, this is the biggest print that we've seen in some time on the month-over-month reading. So that's worrisome. So I do want to call that out as well. So coming back to the markets, one thing I did want to mention. So I think the markets are looking for, again, doing what they did back here, looking for pivot talk, and I just have a hard time with the idea that the Fed is going to hint in any way that they're going to be pausing anytime soon. And even if, again, they may talk about, my prediction, I could just say here, I'm kind of rambling, I apologize. My prediction for the FOMC is that they're going to hike 75, even though, again, this is the odds of 50 basis points only is coming up a little bit. I think they're going to hike 75. I think they're going to mention that it will be appropriate for them to slow the pace of rate hikes and hike at a smaller amount. But then I think that Powell is going to make a point to say that they're basically trying to assert that there's not going to be any rate cuts, that once they get rates up, they are not going to cut them, and that there's no intention to cut them for a while. So it'll be interesting, because the PCE data is the last data point that the Fed's going to have before their meeting begins. And I wonder, it'll be interesting to see how they read the PCE, and along with like personal income and personal consumption expenditures, dollars, and things like that. It'll be interesting to see how they read that data and what they come away with. The other thing I wanted to mention was buybacks. This was posted on October 24th. That was Monday, talking about how Goldman was discussing buybacks, corporate buybacks. So there's a blackout period with earnings, and once the buyback period ends, corporations are allowed to start their buybacks of their shares and things like that. So I do want to call that out as well, because today the blackout period for a bunch of really large companies ended, and so there's a lot of discussion about like lots of money, a couple $2 billion every day coming into the market, which is providing fuel for this. A lot of people have been talking about bearish sentiment, which is causing options positioning to be like options hedging and things like that. I don't have the tweet, I should have found it, but basically I saw this tweet where they were talking about how a large percentage of options were expiring today, and a lot of these, a lot of the options, or a lot of the, how can I say, a lot of the positioning is being affected on a daily basis by daily options that are being bought. So people are buying very, very, very ultra short dated options to try to play these wiggles, to try to play the ups and downs in these market swings. And it's just getting really crazy. And so that's why we're getting so much intraday volatility, where on a day like today, we could be down, overnight, we could be down, over 100 or over 150 points on the NASDAQ. And then by the time we close today, we're up 351 points on the NASDAQ, So like things like that, there's a lot of that stuff going on. So these markets are extremely hard to navigate. But again, until the Fed, a lot of people are, and maybe I'll end with this. I'm not going to look at the other indices or the other markets. Well, actually, I take that back. I'm going to look at crude oil really quick, because crude oil got above, below, and then above again on its 50-day moving average. I think that crude oil is on the up and up. In fact, if you go to my SAMS indicator, this is the first time since June of this year that we got bullish signals across all of the parts of the SAMS indicator, and so I think that that's really important to call out. With the volatility range, or the probable range tightening, I think that this is about to start an expansion, and I think that as we get to the election and there's no political pressure on trying to win votes with the SPR releases and stuff like that, I think we're set up for some big time upside on crude oil. So we'll see what happens as we go into next week. So I did want to highlight that as well. But outside of that, the markets are challenging. I don't think that unless we get a material indication from the Fed that they're planning on changing course, I do think that they are going to come in more hawkish than I think people expect. And I think that you have to be really careful chasing the momentum here. I know there's a lot of discussion out there about the rally, about how high this rally could run because of buybacks, because of CTAs buying in, things like that. But I just think you have to be careful. If you weren't already positioned for the rally, then it's a little too dangerous to try to go after the upside on that. So, but also, you could get destroyed if you try to short this, with this momentum going this way. So I do want to call that out as well. So just be careful. That's all I'm going to look at today. I hope you guys have a fantastic weekend, and I'll see you guys next time.